Welcome back, friends. This is the second part in the video series on my stock portfolio first principles. In this video, I'm going to discuss some of the illustrations, some of the examples of the uh, concepts that we introduced in the previous first video about the operating margins and extremely significant character of operating margins while choosing the kind of businesses that we are going to look out for. Also, we'll look into the examples of net margins. We'll also see the examples of capital structure of the company. And when we made the remark in the last video about how we as equity holders are right at the bottom of the queue of the claimants within the company after the employees and the business expenses and the governmental taxations and the lenders' interest and debt obligations. We come right at the back. So I'll also show you the examples of how does it translate into we choosing wisely about the kind of shops and the farms, so to say, the companies that we are trying to buy here. Just a brief recap. This was my portfolio. As you know, the market has been up for long in these 2 3 days, and so this has gone right to 11 lakhs 25,000. We are not really concerned with this. This I already talked about how the social media cycles are replete with current things, style of thinking, fast changing news cycle, and each one of us is in the business of in the habit of consuming on and on, right? But for us, those business cycles or those news cycles do not matter. We go right to the heart, right to the back of the first principles questions, okay? And that is what we are going to examine here. A good business, which is the equity ownership, is one which drowns in cash, as per Mr. Charlie Munger. And how do we know that a particular business is drowning in cash? There are two very clear signs in the financial statements of the company. One, the cash flow of the company, which is often 2 to 3 times higher than its requirements of capital expenditure. We will see that later in the financial statements of the company. And secondly, very importantly, the company has a very high profit margin. By high profit margin, we mean close to 25% operating margins and close to 13%, 12 to 13% at least of net margins, right? The other aspect about a business drowning in cash is that its long-term liabilities are, or you could say that it's retained earnings here, right? That the business is saving for itself, right? All the previous profits. Its retained earnings or its reserves and surpluses are almost 10x its long-term liabilities, right? So its long-term debt and all the other liabilities would be 1/10 of what the company has reserved from the past profit. That means the company is holding a significantly higher degree of profits and cash within its treasury compared to the kind of obligations that it has over long terms. So for every 1 rupee that it is obliged to pay to some other third party in the long term, by long term we mean more than a year, right? It has at least 10 rupees saved in the treasury for every 1 rupee of obligation. So that is the kind of broad scale in which we are trying to identify the companies which are drowning in cash. I gave you the examples also TCS, ITC. Now please remember that we are not going by the absolute nominal numbers. Obviously, TCS, the scale of TCS is much higher than the scale of, let's say, Colgate Palmolive or VST Industries here, right? So the net, or you could say the absolute amount of retained earnings of TCS would be very high. Like it is around 1 lakh crore rupees, right? If we look at the financial statements of TCS, compared to VST would be having, I think 6,000 or something like this, right? Or maybe 2,000. I'm not even sure yet. Yeah? But we're talking about the proportion. So, what is the proportion? The long-term liabilities of TCS compared to its reserves is again 1:10, roughly, and the long-term liabilities of VST compared to its long-term obligations, long-term retained earnings is again similar to 1:10. That is how we are looking at the companies which are drowning in cash. This is how far we went into it, right? Also, the idea that we are the last, that is both a pain as well as a boon. It is both a curse as well as a blessing. This is an example of how to look at a profit margin. Now, I'm using the app Ticker Tape, right? I primarily use three apps for most of my day-to-day workings on the equity portfolio. My broker is Grow, which is Next Billion Technology. My two research apps are Ticker Tape, on which I prepare my watch list. Most of the screenshots that you're seeing here are from Ticker Tape, which is the pro version of Ticker Tape, which is the paid version. I think 2,000 rupees a year. It is not too high compared to the kind of services and data that they provide. And the other app which I use is, or the other website which I use for research purposes is Screener.in. It's very useful to follow through the quarterly right notes of the company and the quarterly presentations of the company, and also to listen to or read through the transcript calls and con calls of the companies. They're very helpful. So this is the financial page of ticker tape of the company Power Grid Corporation of India. This is the almost a monopoly of transmission power, laying down and power grid and transmission lines, right, of India. This is a government company. Why have I picked this company? This is very interesting. I said that the most important metric that I look for is operating margin, and I think when you look at the kind of companies that Warren Buffett dominates, right, in his portfolio of Berkshire, we are going to see a similar kind of trend here. It doesn't matter whether the company is a capital intensive company or whatever, its margins are obscene, they're filthy. And this, as I said, an operating margin of 25% is good, very good. Look at this operating margin. So this is the financial years, as you can see here. This is the revenue, this is in percentages, annual margin view. So this is in percentages. Revenue earned by the company, 100%. EBITDA, earnings before interest, tax, depreciation, and amortization. Can you see this? So this is government not yet accounted for. The lenders not yet accounted for. Much of the capital expenditure of the company, depreciation, has not been accounted for. What has been accounted for in this spending in these two lines? The employees, the manufacturing cost, administrative cost, selling cost, and so on, which I said business, one part of business, and the employees. These are the first two in the line, right? So once you take them out, once you subtract it, 86, close to 85, 86% has been its ballpark real number, isn't it? This is, guys, this is, what should I say? This is insane. This is insane. I doubt there's any company in India which has this kind of a margin. Because for every 100 rupees that this company earns, after running its business and paying its employees, it still brings back 86 to 87 rupees out of those 100. And we said 25 was good. Just think about it. Three times. Isn't it? Almost three times. Next, profits before interest and taxation. That means depreciation and amortization have been taken care of. So broadly, capex. This is capex, right? I'm again giving you a very practical kind of meaning of this. So after accounting for the capex requirements of the company, that it's a very capital heavy kind of a company, as you can see by the picture itself, right? This is huge, right? There's a huge depreciation. So that means that this company requires huge capex, right? It has huge capex requirements. Still, after that, it has 56 to 58%, right? Roughly here you can see it brings back. So for every 100 rupees, 86 after running the business, and 56 to 58 rupees after utilizing for capital expenditure, right? Or you can say capital expansion, maintenance of its capital assets, heavy assets. Profits before taxes. So who has been taken care of here? The interest lenders, right? Interest. After paying the interest on its loan obligations, it still brings back 37, 36 to 37 rupees. See here? And this is net income after tax. So after paying the government, it still brings roughly 30%, right? Close to, you can say, 28 to 30%, 30 rupees out of each 100 rupees. Guys, I said 13% is really good of a net margin. They have again almost 2.5 times of that. This in this one single financial statement, that is the income statement of the company, you can see the entire capital structure as well as the margins of the company, isn't it? Employees and the general day-to-day running cost here, capital expenditure here, money lenders here, government here. Now once all these are satisfied, this is what we are left with, guys. This is us. This is the portion left for the equity holders. Again, I'm trying to simplify it for you. There are other technicalities here, some minor ones like preferred shares, and some there's also a categorization even within the equity holders. Some are preferred and some are ordinary, right? So for now, we are not going into those, right? Just to keep it very simple, this is the equity stake. And guys, 12.5 to 13% is just too good here, too good. Look at Power Grid. That doesn't mean that the company does not have any sins. Yeah, there are sins in this company. There are certain defects also in this company. There cannot be a company which would be absolutely perfect. But for now, my best and most important metric has been satisfied to the team. To the team. Okay. We'll not discuss these for the time being. I'm just showing you the operating margin example here. Right? Okay. Look at the other one. Another higher. We all know this company, ITC. Right? Again, 100, 35 to 40%. It's huge operating margins, right? After satisfying the employees and the running cost. Depreciation, not much, not much. Because this is an FMCG company, right? Not much. Huge margin still. After satisfying the lenders, because this company does not have debt, so almost no change you can see, right? No interest payments, negligible interest payments. Satisfying the government, see, 25 to 27, 28%. Huge net margins. This is again equity portion. This is where we are standing. Here were employees the standing. Here was the capital expenditure of the company standing. Here were the money lenders. Here is the government, and here are we. This is us. This is our money. So 100 for every 100 rupees that this company earns, it brings back 25 to 27 rupees for us. This is huge. This is the ultimate virtue of ITC. Whatever it might be a meme stock, people might be laughing at it, but this just shows us that this company, above all, drowns in cash. This company drowns in cash. And how would we certify that this company drowns in cash? Not just by this, but now we can go back and look at the free cash flow of the company, and it will just certify it both for Power Grid as well as this one. It's very rare for a company to be generating these kinds of margins with this kind of a low debt and not to have insane free cash flow. It is not possible. Not possible. Okay. Compare this with the other side. On the other side, the retail sector. This is Titan. This is the darling company, isn't it? The sweetheart of the investors. Look at these margins. These are like sickly margins, right? Sick, not as in good, but sick, really poor. This is not the fault of, by the way, Titan. Titan runs in a sector which is low on margins, and this should be one red flag. 100. You look at this. Immediately 10% or 11%. What does this tell us, guys? Compare this number with something like ITC, this number. It is so interesting to know that Titan has such a darling stock in the Indian stock market, and ITC for long had been a meme stock, a joke stock. But you know what? The shareholders holding ITC might have realized much more real cash gains and much more real benefits than the shareholders of Titan. And this is a controversial remark that I'm making. I'm sorry, but does that mean that I'll not buy Titan? I don't know. But one thing is certain: I'm not going to overpopulate my portfolio with these kinds of companies. Not at all. Look at this. For every 100 rupees, it just brings 10 to 11 rupees after the very first settlement, which is the employees and the day-to-day admin. It has the other problem with the company is it has huge debt now again. After the capex, 10.5 you can say. After the interest payment, 10 9, right? After the taxation and everything, 7, guys 5 to 7, right? You look here, 5 6 7%, 5 6 7%. This is what we get as the equity holders. For every 100 rupees, it is bringing back 6 to 7 rupees for us. Just think about it. Now, if leave aside the idea that this is a stock market, or this is a stock, or this is a company, whatever, just think about it in a very personal sense. I had a shop. I was running a shop personally, right, which was bringing back to me 32 rupees for every 100 rupees that I earned from that shop. It was actually go back, bringing it home to bring home, right? It brought me back 32 rupees, and I have another shop which brings me 27, 28 rupees for every 100 rupees that I earn from the shop. And then I have a shop which brings back 7 rupees, guys, on just this one metric. ITC and Power Grid are far ahead of Titan, right? Look at the other one from the same retail. Again, it's a darling stock, isn't it? Same. Retail, you see this? 108 rupees. 6. It has no debts, so that is good. 5, guys, 4.5 to 5%. 4.5 to 5 rupees for every 100. Now, one thing is certain: if I am a high operating margin guy, right, I will have a nightmare if I am holding both Avenue Supermarts as well as Titan. So I have to pick between these two. I can't have both of them. It is just lag on my portfolio. Anybody else can have them. I have no problems. They might be having an alternate thesis. I can't, because for me, a business must drown in cash. And so far, so I can see Titan will not drown in cash. Titan and DMart will always require all of that money to be pumped back in the business. That is the trouble. They will grow insane, but all of that money will not come home. It will be a forever growing stock. That is the trouble. Right? It will be a forever growing stock. So my children and my grandchildren and my grandchildren, all of them will be in the same business. Oh, Titan is such a growing stock, growth stock, right? For the next 100 years, I don't know. Right? That is the trouble, because these margins are not going to improve. So what did I decide? I am holding DMart. I'm not going to hold Titan. That is the reason why I rejected Titan. I had to choose between the two. And the reason why I chose DMart is it has one very important upscale over Titan, and that is no debt. This company is almost debt free. So it at least is good on this part, right? By the way, guys, in the income statement of the company profit and loss statement, which is this one, only the interest payments are shown, right? Why? Because most of these companies raise debt, not like us. We in the consumer finance, if you recall, both our home loans and consumer finance loans, they're EMIs, isn't it? And the EMI is so structured that it contains both principal payment as well as interest payment. That is not the case with these giants or the government debts, right? They are generated primarily through two sources: banks, right, and bonds that they generate. Now the idea of bond is like an instrument where interest payments are made till the maturation of the bond, and then once the bond matures, once the term expiry comes, then the principal payment is done. So what does this mean? That the interest payments are done regularly, year by year or quarter by quarter, whatever be the terms and conditions of the bond. Those are categorized as expenses within the profit loss income statement. But the actual liability, the principal debt, is shown in the balance sheet, right? In the balance sheet of the company as a debt. So that is something which you have to remember. Okay. So these are the examples of high and low margins. Coming back to Mr. Buffett and Mr. Munger, right? That is, this is Berkshire Hathaway. Uh, Berkshire Hathaway is the largest holding company. Holding company meaning that this is a company which holds other companies. It owns other companies, right? And look at the front loading of this company, right? Almost 80%. Again, this is ballpark range, 1 or 2% here or there. It could be, right, but these are the broad numbers. 80% of Berkshire is held by these five companies, meaning that Berkshire holds these five companies and it makes 80% of the total company Berkshire Hathaway, right? It owns, right? Look at this, guys. Apple, we all know what Apple is. 50% of Berkshire Hathaway is made up of Apple, okay? So 50% of the valuation of Berkshire is from Apple ownership. Look at the operating margins of Apple, guys. I said no, 25%. Look at this, 30%. And remember, Apple is I think the largest company in the world, right? Yes, 30%. 30%, guys. What should I say? Look at the debt to equity ratio, guys. 3%. 3% is negligible. It's like no debt. The other one, Bank of America, look at the operating margins of this bank, 30%. Now, debt to equity is 210%. This might look very bad, but again, asterisk. Remember, this is a banking institution. So, obviously, we don't count debt to equity for banks and such credit agencies, because they're in the very business, their very business is that of buying and selling debt. So, therefore, we should not be considering this for the banks, right? For the time being. Look at American Express. Again, their operating margins are low, but look at the net margins. They're able to rationalize it, optimize it. What we get here is, I said no, either operating margins 25% I want, 23 to 25%, or the net margins I want 12% or above, right? 12, 13% above. Look at this net margins. Coca-Cola, guys, 25% operating margins. This is the only egregious part within Berkshire Hathaway. 150% debt to equity. For an FMCG, it is unbearable. This should not be the case, right? This should be not more than 20%. For me, 20 or 25%. Chevron, oil and natural gas, guys. Again, net margins, 12 to 14%. Quite a rational debt compared to the kind of company that it is. Look at the kind of companies, guys: technology, electronics, banking, financials again, FMCG, oil and gas, all kinds of companies. Not like small gap and growth. And the common factor across all these companies is that these are drowning in cash. How do we know this? This and free cash flow, this profit margin and cash flow, and perhaps this will tell us that these are drowning in cash. So this is the general list of my companies, guys. In the media sector, there are total 41 companies in my watch list. In the media sector, Tips, Sarigama, Sun TV. In the consumer discretionary sector, retail sector, demand, consumer staples, which is FMCG, Procter Gamble, Colgate, Imami, Nestle, VST. I told you it's a cigarette manufacturing company, tobacco company from South India. ITC, Unilever. Energy, Reliance. Now, this is slightly a misnomer because, as we all know, Reliance has three giant businesses here: telecom, digital services, media. Energy is there, and there's also Reliance Retail. So it's not just energy. That is what I'm trying to say. Financials, HDFC Bank, HDFC Asset Management Company, mutual fund company, and Bajaj Holdings. This is the parent company of, promoter company of Bajaj Group of Industries like Bajaj Finance, Bajaj Finserv, Bajaj Motors, Bajaj Auto, right? Maharashtra Scooters and all. Healthcare, pharma, and hospitals. Mankind Pharma, Max Health Hospitals, Pfizer, Eris, Abbott India, Capri Point Laboratories. Industrials, Adani Ports, just one. IT, SCL, TCS Wipro, Larsen Toubro Technology Services Ltds, Oracle, Persistent, Infosys, Tata Elxsi, and Larsen Toubro, and Mindtree, right at IIM. Materials such as the chemicals, Clean Science Technology, Linde, NMDC, which is a mining company of Government of India, iron ore mining, SRF, chemical giant, Asian Paint, paint giant, Coal India, mining coals, government company, Deepak Nitrite, Vinthi Organics, and PI Industries, agrochemicals industry. Utilities, Power Grid, I just showed you. So these are the total number of companies that we have here. Okay. Another peek into this idea of operating margins, guys. 1 or 2 years back, I was holding this mutual fund. This is a very elite and very respectable mutual fund, Parag Parit FlexiCap. One unique feature of this fund is that it has an admix of US giants, US companies, and especially IT companies, which have been high margins, and some Indian high margin companies. Right, this very respectable performance and all. Now I have moved out of this mutual fund once I'll not say I cracked the code of equity investing, but just as I started learning, so I started going directly into the stocks. Right, look at the kind of holdings here: HDFC Bank, Bajaj Holdings. I said not Bajaj Finance, but Bajaj Holdings. Something is going on, guys, here. ITC, I just showed you, right? Come here, Coal India. I showed you, right? Power Grid Corporation. Once I looked at their holdings, I was surprised that, oh, it is holding Google here, Alphabet. It is holding Facebook. It is holding Apple. Why is it holding Coal India and Power Grid? These are such abused stocks, isn't it? They have destroyed the capital. They have not grown capital much. And why would you hold Bajaj Holdings instead of the darling Bajaj Finance? And then I realized what was the reason why were these are cash giants, guys. The only misnomer here, the only, you can say, outlier here is Maruti Suzuki. Maruti Suzuki is, as you know, auto manufacturer and has very low margins, very low margins. I don't know why they have it here. Maybe because it is a loaded company, but that is the only anomaly. The rest of these are very good on margins. Axis Bank, for the reason that it is very cheap, I think, not because of its margins. I hope so, but because it is very cheap. But you see the remaining pattern here, guys. All are high operating margin companies. Go for cash. Go for cash. Look at this. Out of the 41 shortlisted companies, guys, 35 of them have that criteria of high operating margins, more than 25% or more than 13%. All of my media companies are high operating margin companies, insane operating margins. Tips, Saregama, Sun TV. All of my FMCG companies are high operating margin companies, right? All of my financial companies are high operating margin companies, all three of them. Bank, HDFC Bank, HDFC MC, and Bajaj Holdings. All of my pharma companies are high operating margins. High operating margins, right? I rejected Sun Pharma, although Sun Pharma has very high margins, but I'll tell you the reason maybe in the next video. Industrials, again, only one I had, Adani Ports, and this is again insane high margin. Again, that doesn't mean that these companies do not have defects. I'll show you the defects also. But for now, just look at the virtue. Information technology, IT companies, only two companies which are low on margins. By low, I mean not disastrous, but I mean not meeting the 25% threshold or the 13% threshold. One is Wipro, and the other is Persistent Systems. Right? Materials, barring Asian Paints and Deepak Nitrite, all of them are here. only two, Deepak Nitrite and Asian Paints, are not here in high margins. Or that doesn't mean again that Deepak Nitrite and Asian Paints have very low margins. No, not like Titan or Avenue Supermarts, right? Utility, power grid, we have already seen this. Is retail. I mean Reliance as well as DMart, right? They are all really low on margins. If you look at the companies which are low, poor on margins, I already showed you both these, right? DMart and Reliance. DMart and Reliance. Here also, I guess Reliance is only being destroyed for margin because of Reliance Retail, not because of its petrochemical, not because of its telecom, because telecom is a very high margin business. It is because of the retail sector that this margin has been destroyed. Still, why am I invested in Reliance? Because I think and I have a sense that it is going to be demerged. And then, and because of the scale of Reliance, I think if I had to hold one or two low margin companies which show potential in future, Reliance is a good bet for me. Right? And DMart. Why not Titan? Because I had to just minimize this list. I can't maximize. I can't be having like 5 or 10 odd companies here in these kinds of margins. I can't. So I had to choose between DMart and Titan. I chose DMart. Right? So for now, I'll stop this video here just to show you the examples of margins and why margins matter. Just a brief recap here, going back to the this one, guys. This is very important, right? Employees are settled here. This is the capital structure. The business running cost is settled here. The business capex is settled here. The lenders are settled here. The government is settled here. What comes out as a residue is ours. 100 rupees, 7 rupees, right? 100 rupees, 5 rupees, right? And 100 rupees, 27 rupees. And 100 rupees, 32 rupees. This is also a good way to compare because remember the scale of Power Grid is not the same as the scale of Titan. Power Grid is a much larger company in terms of cash flows and profits and revenue, right? But once we start evaluating them in their percentages, then we start seeing the differences, isn't it, between them. So once we convert them, reduce them to 100 rupees, which is the percentages form, then we start seeing the difference between the nature of these companies, the nature of ITC, Power Grid on one hand, and the nature of Reliance, Titan, and DMart on the other. So I hope this video was useful. This was just an illustration of the capital structure as well as the operating margins and the net margins, how they are extremely relevant for cash rich companies to identify cash rich companies. And we can look at them by just observing the financial statements of the company. The app is Ticker Tape. For now, I wish you well, guys.